Real estate investment. A comprehensive guide. Real estate investment is a time-honored strategy for building wealth, generating passive income, and diversifying an investment portfolio. Whether you are a seasoned investor or a novice looking to make your first purchase, understanding the intricacies of real estate investment is crucial for success. This video will delve into the various aspects of real estate investment, including the different types of properties, investment strategies, financing options, market analysis, and more. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding real estate investment. Real estate investment involves the purchase, ownership, management, rental, or sale of real estate for profit. It is a broad field that encompasses various types of properties, including residential, commercial, industrial, and land. Types of real estate properties. Residential properties. These include single-family homes, condominiums, townhouses, and multi-family residences. Residential properties are often considered the most accessible entry point for new investors. Commercial properties. These include office buildings, retail spaces, hotels, and other properties used for business purposes. Commercial real estate typically requires more significant capital investment and offers higher returns. Industrial properties. These include warehouses, factories, and distribution centers. Industrial properties can provide stable, long-term returns but may require specialized knowledge to manage effectively. Land. Investing in undeveloped land can be a long-term strategy. Investors can profit from land appreciation, development opportunities, or leasing the land for agricultural or commercial use. Real estate investment strategies. Buy and hold. This strategy involves purchasing a property and holding it for an extended period, typically to benefit from appreciation and rental income. Flipping. Investors purchase properties at a low price, renovate or improve them, and then sell them at a higher price. This strategy requires a keen eye for undervalued properties and a good understanding of the renovation process. Rental properties. By purchasing properties and renting them out, investors can generate a steady stream of passive income. This strategy can be applied to residential, commercial, and industrial properties. Real estate investment trusts, REITs. REITs allow investors to pool their money to invest in large-scale properties. This is a way to invest in real estate without directly owning or managing properties. Financing your real estate investment. Securing financing is a critical step in the real estate investment process. There are several options available to investors, each with its advantages and disadvantages. Traditional mortgages. Traditional mortgages are the most common financing option for real estate investments. These loans are provided by banks and other financial institutions and typically require a down payment of 20% of the property's purchase price. Hard money loans. Hard money loans are short-term loans provided by private lenders. They are often used by investors who need quick financing or cannot qualify for traditional mortgages. Hard money loans come with higher interest rates and shorter repayment periods. Private money loans. Private money loans are similar to hard money loans but are provided by individuals rather than institutions. These loans can be more flexible in terms and conditions. Home equity loans and lines of credit, HELOCs. If you own a home with significant equity, you can use a home equity loan or HELOC to finance your real estate investment. These loans allow you to borrow against the equity in your home, providing a low-interest financing option. Seller financing. In some cases, the seller of a property may be willing to finance the purchase. This arrangement can be beneficial for both parties, as it allows the buyer to avoid traditional financing hurdles and provides the seller with a steady income stream. Partnerships. Forming a partnership with other investors can help you pool resources and share the risks and rewards of real estate investment. Partnerships can take various forms, including joint ventures, limited partnerships, and real estate syndications. Analyzing the real estate market. Successful real estate investment requires a thorough understanding of the market. Analyzing market trends, property values, and economic factors can help you make informed decisions. Market research. Conducting market research involves gathering and analyzing data on property values, rental rates, vacancy rates, and other key indicators. This information can help you identify promising investment opportunities and avoid overvalued markets. Comparative market analysis, CMA. A CMA involves comparing a property to similar properties that have recently sold in the same area. This analysis can help you determine a fair market value for a property and assess its potential for appreciation. Economic indicators. Economic indicators such as employment rates, population growth, and GDP growth can provide insights into the overall health of a real estate market. Strong economic indicators often correlate with rising property values and rental demand. Property management. Effective property management is crucial for maintaining the value of your investment and maximizing rental income. Whether you choose to manage the property yourself or hire a professional property management company, there are several key considerations. Self-management. Managing a property yourself can save money on management fees, but it requires time and effort. Responsibilities include finding and screening tenants, handling maintenance and repairs, collecting rent, and dealing with tenant issues. Professional property management. Hiring a property management company can help you handle the day-to-day operations of your investment property. Property managers charge a fee, typically a percentage of the rental income, but they can save you time and provide expertise in managing tenants and property maintenance. Tenant screening. Finding reliable tenants is essential for maintaining steady rental income and minimizing vacancies. A thorough tenant screening process should include background checks, credit checks, and verification of employment and rental history. Maintenance and repairs. Regular maintenance and timely repairs are crucial for preserving the value of your property and keeping tenants satisfied. Establish a maintenance schedule and set aside funds for unexpected repairs. Tax considerations. Real estate investments come with various tax implications that can impact your overall returns. Understanding these tax considerations can help you maximize your investment's profitability. Depreciation. Depreciation allows you to deduct the cost of a property over its useful life. This can provide significant tax savings, as it reduces your taxable income. Residential properties are typically depreciated over 27.5 years, while commercial properties are depreciated over 39 years. Capital gains tax. When you sell a property for a profit, you may be subject to capital gains tax. Long-term capital gains, for properties held for more than 1 year, are taxed at a lower rate than short-term capital gains. I, Professor Lee, thank you for giving me your valuable time for watching the video.